us. Well, it's a good time to then get our conversation going with the market master this morning. Saurabh Mukherjea, founder at Marcellus Investment Managers, is with us. Saurabh, good morning. Great to have you on the show as always. Been a long time, at least, that I've had a chance to chat with you. Tell us, the market seems to be at a very interesting juncture, and earnings season has started off in the reverse mode, right? Typically, it's IT that starts it off in style, and then you have the tail enders coming in. But as you look at the market right now, how are you feeling? Do you think earnings will live up to expectations? Because the rest of the picture, whether it's the dollar, US yields, US recession, there's a lot of confusing elements that are out there.
So, morning, Subhi, I think if you look at the two big profit generators that have reported so far, right, HDFC Bank and TCS, I think respectively the second and third largest profit generators in India. I thought those were really good results. So I taken both our portfolio stocks for us. So disclaimer here, I own them. My parents through our portfolios, through Marcellus's portfolios own them, and so do Marcellus's 10,000 clients. So HDFC Bank is 21% profit growth, 17% loan growth, and HDFC Bank has been doing this for 25, 26 years, nothing new here. And even TCS, in what's supposed to be a US recession or close to a US recession, TCS is growing profits in mid-teens. Some of the strongest order book growth I've seen in many years, 25% operating margin. TCS's guidance is also very strong. So I thought these were sparkling results. And if you consider that this comes in the context of a world in which the relationship between the West and China is deteriorating by the week, and therefore the probability of heavy FII flows into India is growing by the week. We've already seen some of that come through this month. I think this is a very nice situation. You've got big Indian companies like TCS, like HDFC Bank, reporting sparkling results. You've got FII flows coming in, the world tilting towards India, the domestic economy in good shape. So difficult to really imagine what more would a long-term investor expect or want from either big Indian companies or from the Indian economy.
Saurabh, I take your point that you've been invested in TCS for a while, but I don't know how you can call these results sparkling, because in TCS's own admission, the sentiment has weakened in Feb and March. Their constant currency growth was not even 1%. Their margins that they reported were under their own guidance, below 25%. So in what context are you calling it sparkling? I'm asking because at a time when the recession has not even kicked in, you're seeing numbers like this. So what happens towards the end of the year? This is Sonia.
Sorry, Sonia. The hallmark of all great Indian companies, right? All the great Indian compounders always downplay results. I've never seen, say, a Pidilite or a Titan or a Nestle or an HDFC Bank or a TCS hype up the future. I've never seen a single high-quality compounder hype up the future. So TCS is publishing results at a time when you've had about 4 large Western banks going under in the preceding 4 weeks. What would we expect them to say? It would be bonkers for them to say that the outlook is great. And why should you and I care about 2 months, 6 months, 1 year forward guidance from a company which has been around for 40 years, which has been listed for 20 years, compounding consistently cash flows and share price at 20% for 20 years? Why should you and I lose too much sleep about guidance, right? Look at the results. Look at the operating margins, look at the deal wins, look at the YOY growth in revenues and profits. Consider the environment in which these people are operating. How these results are anything other than sparkling beats me. And why people look at guidance from companies which have been reporting for 80 quarters as listed entities, companies that are known to be conservative in how they think about the future. That's how great companies think. So in every which way, for anybody who's watching this, if you care about long-term investing, these are good results from proven companies. They're giving you a sensible picture of the world. They don't hype up their stock. They do the right thing for their shareholders. And in a difficult world, a world in which the China and the West is at loggerheads with each other, a world in which 4 Western banks have failed in the last 30 days, in a difficult world, these are outstanding results, I think.
Okay, all right. Hi, Saurabh. Good morning. Nigel on this side. So we take your point then. For a long-term investor, TCS could be part of your portfolio now, given that we're likely to see some bit of softness. Got that. What about the pharma space? In the past, we've asked you about Divi's. I think the last time we chatted as well, you said it's a quality franchise. It's going to be looking up from here on. And you had maintained that you all will add positions, at those levels. Now, from those lows, the stock has risen a little bit, and the export data that was reported was quite positive. Do you think Divi's will look up from here? From the peak, it seemed quite a large correction. So I ask you.
So November, December, we doubled our position. So I think going into Oct now, I think it was 3% of consistent compounders. And then through Jan, Feb, we made it close to 8% of the portfolio. So it's a big holding for us. And again, similar position on Divi's, right? They too were listed around 20 years ago. So if you look at the 20-year track record, this is a company which from nothing has built itself into the 5th largest API manufacturer in the world. I would say amongst the large Indian pharma companies, by far the highest return on capital generator. You speak to any Divi's client. Divi's clients are the world's largest pharma companies. I would say 6 of the world's largest pharma companies, I reckon, account for around 80% of Divi's profits. You speak to them, as we do quite regularly, and they are giving us a very clear picture that America is turning away from China as a source of API. China makes 90% of the world's API. As America turns away from China as a source of the world's API, Divi's is a natural place for them to go to. What Divi's did on Molnupiravir over COVID has won them many friends in the West. So for those who have short memories, in the space of 100 days, Divi's delivered for Merck Molnupiravir, and Merck thus supplied the whole world with Molnupiravir in 100 days flat, at a time when global supply chains were supposed to be in trouble, courtesy China, courtesy COVID. So impeccable track record of high quality delivery to the world's largest pharma companies, and therefore we unhesitatingly doubled the position through the winter months. The export data, whatever it is perked up now, but short-term data we don't lose too much sleep about. Focus on great companies with impeccable governance, capabilities, distinctive capabilities that their competitors don't have, and buy as much as you can when others are refusing to buy those stocks. That's something we've done for a long time. It served us in good stead. I think in Divi's lab as well, our expectations over the next 2 to 3 years, this company will get plenty of business from the Western pharma companies.
Let's talk about a sector that you've tracked for very long and companies that you've sort of looked at for several decades now, I guess, Saurabh. I'm talking about the consumer names. And if I'm looking at the right disclosure sheet, then Nestle, Page, Pidilite, all of them are still in your consistent compounders. What's the thought process here? Because again, there's been a debate about how the lower end of the consumer market is getting impacted because of high inflation, high interest rates. It's all about the premium end, but that's not what FMCG represents. So how are you looking at it, considering we don't know, the monsoon is a joker in the room right now. We don't know if it sort of gets worse before it gets better. What are you expecting? I know I'm not talking about the long-term question, but in the near term, let's say this year, what are you expecting the consumer companies in your portfolio to do?
So look, I think I'll also add Amritanjan. So in our Little Champs portfolio, we also have Amritanjan. And as almost everybody in India now knows, we used to own Relaxo. So if I split this into 2 parts, right, and this is, I think, a relatively established structural trend now over the last 6-7 years, and I reckon this will last for several years to come. The strata of society that, say, represent CNBC viewers is doing very well. Whether it's their investment portfolios, whether it's their cash flows in terms of earnings or their business profits, the strata of society represented by the viewers who are watching this program is doing very well in India. And any play around that, whether I look at our investment in Titan or Asian Paints or indeed Pidilite, any play around affluence, middle class, upper middle class affluence in India, we're seeing sparkling results. When we talk to the management teams, we're seeing enormous confidence about the years ahead, and we can also see heavy capex, right? So, for example, Asian Paints 5 months ago announced $1 billion of capex. Pidilite, I think, the best part of $1 billion of capex, and so on. So that part is relatively straightforward, and we stay heavily invested in all of these firms, Titan and Asian Paints, Pidilite, and so on. The part that is struggling, Surbhi, you're right to point out, is anything which caters to people earning, say, 2 lakhs per annum or less. And I would say around 300 out of India's workforce of 500 million, I would say 300 million earns 2 lakhs or less. That's the strata where there seems to be a real challenge with income going faster than inflation. Effectively, real wages are going down for these people. And that's why, in our Relaxo investment, the chappal piece took such a tonking. And say in our investment in Amritanjan, Even in the pain relief space, we're barely seeing that volume growth. So we are concerned about the fact that people earning 2 lakhs per annum or less in India, their incomes have stagnated over several years now. We're trying our best to figure out what the future holds for the strata of Indian society. But at the moment, I have to confess, the outlook does look grim for companies catering to the lower end of society. Thankfully, Nestle with its premium infant milk offerings and increasingly more premium offerings for pets, for babies, Nestle has very nicely, very cleverly premiumized the portfolio. And hence we sit quite comfortable with our investment in Nestle. They've grown volume growth at 9-10%, but other FMCG companies have struggled to do that. I think Suresh Narayanan and team have done a spectacular job over the last 6 years in dealing with the shift in India, where the rich are getting richer and the poor are getting poorer. Nestle has repositioned the portfolio, I think, very smartly over the last 6 years to play the affluence of, just to keep it simple, to play the affluence of CNBC viewers, and therefore we stay happy investors in Nestle.
Okay, that's on the consumption piece. But I do want to come back to this discussion on IT, Saurabh. I take your point that, it's a hallmark of, excellence when a company comes out with a conservative guidance. I get that. But what do you do when a company comes out and tells you straight up that there are cancellations that are taking place? I'm not talking about TCS, but Infosys, right? I mean, not only was the commentary uninspiring, but the company said that forget about deferrals, there are also cancellations that they're seeing in certain sectors. Now, those are some alarm bells that you need to look at. So if you're a long-term investor, say in a stock like Infosys, what do you do at a time like this? Do you just take a step back? Do you churn out? Because that's clearly what we're seeing large FIs do at the moment.
So Sonia, I'll tell you what we did this morning. In fact, just before I joined the call, I was discussing with my colleagues whether, Infosys looks tasty at the share price to me. Because, I don't see a problem here. This is a proven company. The great Nandan Nilekani is the chairman here. Salil Parekh's done a super job as a person running the company. I don't think the Western banking crisis is some sort of permanent state of affairs for the Western world. As we all know, it's been triggered by the Fed's rate hikes. I don't think the Fed's rate hikes are going to last ad infinitum. From what I know, only 30% of the Western companies have transitioned to cloud. So transition to cloud becomes a necessity for the other 70%. Technology is becoming more and more relevant for the whole world, including for the West. So given the scale of the opportunity in front of Infosys, given their track record, given their capabilities in helping Western companies transition to the cloud, I don't quite see what the dilemma is here. Yes, much like say Divi's Lab exiting COVID, if you have 4 banks blowing up in the Western world, you're bound to have some clients cancel your order book. If you're a large IT services company like Infosys, it'd be astonishing if some clients didn't cancel their orders. I mean, these are CEOs of Western companies. They're seeing banks will blow up in front of them. They'll cancel the orders. But should you and I get lost in that noise? I don't think we should. And this is where I think equity investors get a bad name when they sell Infosys on the back of the results earlier this week. I think sensible people out there should consider buying rather than selling Infosys at this juncture. We don't have it in CCP, but as I was saying, the way it got tonked, it looks to me to be a great opportunity in a company which has proven itself over now the best part of 30 years of compounding and 30 years of becoming more and more relevant for the Western world, a Western world which needs Indian IT services companies now more than ever before.
All right, Saurabh, just to clear the point, so you'll prefer TCS over Infosys as of now, but Infosys, it still looks like a very well-run company, and you'll are still studying it, right? So TCS over Infosys as of now.
Yeah, the smaller IT services companies we don't get so enthused about because they don't have the muscle. They don't have the muscle, the negotiating power, the recruitment power to deal with the scale requirements of large Western companies. But TCS and NP do. They're able to recruit successfully and cater to large Western companies.
All right. Well, differences of opinion make a market, right, Saurabh? And we're taking note of your points as well. Saurabh, final question before we let you go. You briefly mentioned that Amrutarjan is one stock that you all have entered and Relaxo is one that you all have got out. And when we chatted the last time as well, you pretty much had mentioned these two. Any fresh additions that you all have made, say, in the last couple of months or so, if you could share with us, or any stock that you all have exited as well?
So in our financials portfolio, Kings of Capital, we've added a company called Prudent Corporates. So these guys run a platform on which 25,000 IFAs work. So these are IFAs who cater to, say, middle class people, lower middle class people. The IFAs go and sell the mutual funds, life insurance, general insurance. Prudent Corporate provides the platform. So it's basically let's call it a wealth manager for the mass affluent in our country. And we like the financialization theme, and we think Prudent Corporate is an interesting way for our clients to benefit from the financialization of, say, CNBC versus wealth.
Okay, all right. In fact, I was just going through the stock. Last year, I think the stock was at, 500 rupees? And now it's had a fairly decent run, 811 right now. That's the one you're referring to, right?
That's right, yes.
Okay. All right. Saurabh, we'll leave it at that. Great chatting with you. Thanks a lot. A very interesting and enlightening discussion. But we have